Hey guys, David Robinson here. Welcome to the Apartment Investing Journey. Another great episode for you today. Another great guest. We've got Jamie Gruber with us today. Jamie, welcome to the show. Appreciate you coming on.
Hey, man. Thanks for having me. I appreciate it.
Yeah, my pleasure. So Jamie is a multifamily real estate investor, partner with Canovo Capital, and founder of the multifamily and more networking community. Jamie is a former insurance executive turned investor, course creator, and mastermind leader. And he's married to Sylvia, and they have two sons, Sebastian and Julian. And he's based out of, I believe, Ann Arbor, Michigan. Is
Just
that correct?
North, yeah, just outside of Ann Arbor. Yep.
Okay, great. So, Jamie, our podcast is all about the journey. We're excited to get into your story and learn more about how this all came to be for you. But let's back up and let's tell us about how this all started for you. What's your background and how'd you get into multifamily real estate?
Yeah, so I'm a native New Yorker by way of Boston, and now a 5-year Midwesterner here in Michigan. And all of that path really started with kind of a standard upbringing. Went to school, didn't love college, kind of in and out of it, never finished, but got a job at an insurance company because I had a friend there. So needed a degree. I didn't have one, but he got me in. So I started as a claims adjuster at 21 years old, 21 years ago, a little over 21 years ago now, almost 22. So I was 21 years old, and I started in this job, and I was pretty good at it. So I kind of kept climbing the ladder there. A couple of years later, they made me a supervisor. A year later, a very young manager. So I was kind of like, I had a team of leaders along with adjusters beneath me, and I'm 24, 25 years old. And I just wanted to see what else I could do. So I started down the path of trying to reach this executive status. And that was about call it a 13 or 14 year journey from that point. Again, moved to Boston, kind of came in there, took another level job. I took any job I could, travel for 42 weeks a year, no problem if that's going to get me to that next level, and eventually landed the job in Michigan. Right around that time, I was starting to feel a bit of a disconnect, but the job search or the trying to get to that executive level always felt like, okay, but it's because I'm not where I want to be. I could feel this disconnect from my job, but it's because I'm not where I want to be yet. I haven't hit that level. So I started reading about real estate, kind of reread Rich Dad, Poor Dad. It made more sense. I had read it early in my 20s. And I had a single family home that I couldn't sell when I moved from New York to Boston. It was 2008. So I had that home. I had been renting it, and I kind of, got my head around that being my first rental property, really, even though I had it for years. I kind of kept it in mind. And we bought a couple of duplexes and did the Burr strategy that, Brandon Turner made famous on Bigger Pockets. And that was right around when I moved to Michigan. So I'm in Michigan now. I've got this little portfolio of 5 units, and I got my dream job, but then felt completely lost in it. It was like all of the sense or feeling of this isn't for me. I pick up my family, I move them to a place I've never been before. We settle in. I've got the dream job. And it was like, hey, I've been trying to tell you this isn't for you. So that set off a very dark year for me, even though it was the job I wanted, a very dark year. Real estate seemed to be the light for me. Like there's a way out. If I can, go into this real estate thing and really, invest heavily and find property, but buying 2 duplexes and rehabbing them, that was so much work. And it's like the Dan Sullivan saying 10X is easier than 2X. It felt like, well, why not buy apartment buildings? So I joined a community. I met a partner. We started a community together called Multifamily and More, which you mentioned. That brought us our first deal, which is a 16 unit, which I'm happy to decomp. Later on, a friend of mine that I had built, within this network brought a 22 unit to me in Cleveland. I closed on that. And then later, again, we had another 22 unit under contract fairly recently in Metro Detroit that we actually ended up wholesaling to another buyer because we ended up partnering. My partner and I ended up becoming partners with Canovo Capital, which I can get a little bit deeper into here in a minute. But that's kind of been my path. And, the between that and some other things that I've done along the way that got me out of my day job about a little less than a year ago now, from the time that we record this. And I've been kind of rolling in the real estate course creation mastermind space ever since.
Oh, that's great. Well, congrats on exiting the corporate career. I guess congrats. I assume that's that's a
big movement. I mean, if you're talking a multi-$100,000 a year type of position, stock and equity every year, restricted units. I mean, there's a lot to walk away from. But when it was clear to me that my heart wasn't there, when I made that leap, kind of closed my eyes and stepped forward, it was amazing to see the amount of opportunities that would come at me as a result of that. So, yeah.
That's a good point, and I think overlooked in many cases. Do you, in hindsight, do you wish you would have done it earlier?
No, I don't believe in regret. I think our journey takes us to wherever we need to be when we need to be there. And the other part of that too is I think, for those that are in the W-2 job and they have this real estate business they're building on the side or whatever, you really need to build it to the way in which you want to so that you have something to run toward. I always think this. Had I quit when I was, not feeling great about my job, I would have been running away from it. And I think that's very dangerous. Like you sort of like you bust out of the door and you're like, yes, I'm done with that. But then, like you're looking ahead at and now what? Like I got a duplex. Like what do I do now? So I think you have to build something that you're ready to run toward, right? I think that's a very important distinction. So when I quit, it was at a point where I had gotten through a lot of personal work to kind of overcome the challenges I had in this new job. There were a lot of variables in there, tough boss, all that stuff. I had built a bit of a real estate a portfolio, not honestly at the time enough that I would say like I replaced my income, not even really close to be honest with you, but I had some other irons in the fire. I had found purposeful work and other things that I was doing, and I was ready to leave my job with gratitude for what it had produced for me, as opposed to being that thing I don't want. And we tend to know that. We tend to know what we don't want, but we often don't know what we do want. And I needed that time and space to get to a place where I knew what I did want.
Yeah, that's a great explanation. I love the concept of building something that you're running towards versus running away from something. Let's fast forward a little bit. Tell us what your business looks like today and what you guys are focused on.
Yeah, so we've got 40 units total of real estate. We've moved around those singles and duplexes. We have the 16 to 22. Again, we walked from another 22. But yeah, partnered up with Quantum Capital as a part of the general partnership there. We've closed on 4 deals within a fund that we're raising for. We have a 5th under contract that'll close early next year. And we expect to probably get 7 or 8 total assets acquired in that fund. And these are, 20 to 40 unit distressed mom and pop workforce housing type properties in significant markets, LA, Austin, Phoenix, Denver. We have quite a bit in Denver right now. So really kind of doubling down on undervalued assets. Rent isn't where it needs to be, but on top of that, finding markets within growth markets, if you will, that also accelerate the valuation.
Interesting. And so tell us, this is an investing strategy or thesis that I don't see very often. I get a chance to interview a ton of investors. So tell me a little bit about the mindset around your thesis and strategy.
It's funny, when I was investing for my own stuff, it was always like, well, value add, cash flow, right? I get value add and I can increase the value and get cash flow. But all of the appreciation I would force in markets I'm looking at, like Michigan, Ohio, maybe even a Kentucky, so those sorts of markets, right? Like all those markets, you force appreciation by looking at, okay, NOI is not suboptimal, right? Paying too much for garbage, not enough coming in on rents. You kind of create that spread, that NOI by a stable cap rate, because these markets tend to kind of have a pretty flat cap rate, means, you add 50, 80, 100, 200, $300,000 in value to an asset, which is great. What opened my eyes with my partner, Mark Henteman, and there's 5 of us total that are a partnership in Quantum Capital, but he's the principal. What opened my eyes with him was he said, look, I don't think about cash flow. And this is a guy that's from Cleveland originally. He's like, cash flow, I don't know of anybody that thinks about real estate as cash flow that's, an ultra successful investor. He's like, what's the number one rule of real estate? And I didn't know the answer to that, but he said it and then I knew, and it's location, 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 right? So if you take a strategy of finding distressed assets, and you've got, in Mark's case, the systems and processes built and the broker relationships to find these assets. I mean, we're out of contract on it now, but we were under contract on a property in Scottsdale that rents were $1,200 below market, $1,200 below market, right? Like property didn't work out, but we were initially under contract on that. When you can find those value add properties like I'm finding in Michigan, and then pour the lighter fluid on it of the market dynamic being one that is going to grow, like, population growth, inflationary growth, rent growth, all of that stuff in that specific market. To me, that's the perfect storm of how you really execute a value add strategy. You defer a little bit of cash flow for the value add play that you have. And when you refi or sell that asset, you're talking 3x multiples on the valuation. Whereas in a Michigan, you might be talking like a 30 or 40% increase in value.
Yeah, well, and I love that. And let me ask you, moving forward, do you see the exit more often? I'm sure it's case by case basis, but do you lean into refinance or do you lean into sale
on
personal
this type
stuff, of project?
On my personal
on this stuff that you guys are buying and sort of with this thesis, do you see yourself exiting or refinancing, leaning into the refinance, or are you looking more for a disposition?
Yeah, no, there'll be, well, both. I mean, we'll refi traditionally around year 3. We'll return a certain amount of investor capital and then exit. So it's a full syndication model. It's a fund. We're raising a 506B, right? So yeah, there's got to be an exit. Really, we're not keeping the assets long term. We're going to exit after, the target's about 5 to 7 years, and return.
But would you sell in year 2 or 3 after you complete the deep renovation plan or stabilization plan? I mean, because you're targeting a distressed asset here, with a significant gap between where it can be and where you're buying. Are you guys looking to potentially sell in year 2, 3, 4, or
I would say
refinance and then sell? Yeah,
I would say could, and that's the beauty of a fund, right? Like in the fund, we have certain, any deal that you present, whether it's a single deal or a fund, you're going to present certain, variables, IRR, equity multiples, all of that. So I would say if we hit all of that or exceeded all of that in a short time frame, in year 2, year 3, and it made sense to dispose of the asset, sure. I know there was one in Austin that was purchased before I became a partner. This is a single syndication. The numbers might be a little off, but just for the sake of, I'm within reason here.
Yeah.
Acquired for $6 million. Exit strategy at year 5 is like $12 million. By year 3, there was a broker estimate of 14. Yeah, I believe on that one, the decision was we're going to exit. So
gotcha.
within a fund, we can play with that a little bit, right? Like, this asset's hitting, above and beyond what our return was going to be in 5 years. Get rid of it. These other ones we can hold longer term, so on and so forth. So not out of the question.
Well, and as it relates to the fund, is there a particular cash on cash return that you're looking to target for your investors that are investing in the fund?
We're in that 7 to 9% range for cash on cash.
Yeah. All right. So really, if you can get multiple deals in this fund sort of churning and exiting at the right time, whether that be through a refinance or a sell, then you can continue to push, but you're not really looking for cash flow out the gate.
No, in fact, the way we have it structured are with 3 different shares, right? So you have your A-class share, which is sort of an equity pref model where you invest $100,000, but you don't get the upside on the equity, right? But we're going to pay you first after the debt, and we'll pay you a 10 pref on that. So you'll get a 10% pretty much guaranteed, as much as a pref can be guaranteed, paid quarterly. You'll get 10% of your investment, annually paid quarterly, if that makes sense. And then after that, Class B, Class C shares, of course, are going to share in the equity upside. But year 1 might be a 2 or 3% return, right? Year 2 might be 4 or 5. We get to year 3, we refi, we can shore up that pref. If it's an 8 or a 10, depending on when you invested, we'll get you to your pref, and then the remaining amount would be return of capital. And traditionally, around year 3, Quantum does the refi. Around year 3, when they do the refi, they're returning 50 to 70% of the original investment. And the exit traditionally happens around year 5.
Yeah, love it. Thanks for that explanation.
Sure.
Well, let's talk a little bit about this transition for you, moving from being, this solo investor, buying stuff for your own portfolio, to joining a larger team and playing a role inside of a team. What has that been like for you?
It's been excellent. I mean, for me, look, my journey out of my W-2, and I think for anybody that's looking to do that, the big question, I'm 43 years old, right? So I'm 41, 42, and I'm considering this exit. And the big question when I finally left that I got from other 41, 42, 43-year-old executives at my company, and even older than that, was like, how are you doing this? And then they would say, I don't know what I would do. I have no idea what else I would do. So for me, it was an iterative process. And I think people have to be okay with transitioning through pivots. So in other words, you start with saying, okay, real estate, that seems like the path for me. So I went and bought, like I said, a couple of duplexes, and it was like, maybe not duplexes, multifamily. So I go multifamily, and I'm like, man, I'm going to be a multifamily investor. That's what I'm going to do. So I buy multifamily property. You know what I loved about buying multifamily property? It was the finding the deal, the interaction with the seller, the whole process, the people aspect. You know what I hated about buying a multifamily deal? Was operating it. Hated it. Me operating it. We have a manager and all that, but still hate the operations part of it, right? So that turned into, well, okay, I can continue to build this. I want to keep building this, but hey, I really like these interactions. So that's where the course and the mastermind stuff came in, right? But within real estate, what I realized by learning from Mark was his words to me were like, hey man, you're a great connector. I need a guy like that in my company. So I've broken this out. I do webinars on this. I believe there are 3 real estate superpowers that you have, that anybody has. I think you are either a great integrator, you're a great connector, or you're a great analyzer. I think, generally speaking, there's a visionary. I think you earn that role
Sure.
as you do those others. At some point, you start your own capital company, you're a visionary. But for me, the transition allowed me to lean into my real estate superpower. I don't deal with the operations of the asset management. I don't want to. I mean, I sacrifice a share of equity because of that? Yes. But I also get to do things like go to the Dominican Republic for 3 or 4 weeks. As I told you, right after this interview, we're heading out of town for a while. I also get to do other things like that. And I get to talk to people about the asset. I get to get them excited because I'm excited. I get to share what I'm gifted with. And I never understood that what I am or who I am or how I interact or connecting people with other people was a gift. I just thought it was like something people do. Like, what's so special about it? But for me, it's my gift. The guy that can integrate a vision, that can look, or gal that can see the vision and say, I know that every block and tackle that needs to happen, and I can see the entire playing field. That's a gift. They may not realize it, but that's a gift that a visionary needs. Take my vision and integrate it. Or for me, give me every analyzer, man. I can go through and underwrite deals, but I want to cap myself after about 45 minutes of doing this. There are guys and gals out there that'll spend 8 hours doing it, and then they'll run home and they'll research the next car to buy. They'll stay in the data all day, all night with energy. I'll do this podcast, 6 of them in a day, and then go out and have drinks with friends afterward. That's where I get energy. So teaming up with a capital company, with a company, and leaning into my superpower has allowed me to avoid the stuff I don't like and do the stuff I really do like within the confines of, or the structure of, somebody else's incredible creation. So it's been great for me.
I love it. Well, great explanation. We talk a lot about, finding, your unique skill set and leaning into that, and then finding, going another layer deep and saying, all right, how can I bring that to an organization that's already, there, but bring my superpower into that space and expand upon what I'm already doing, what I'm already good at. I love that. So let's talk a little bit about, your role inside that space of being a connector, marketing and raising capital. What has that looked like for you as you've stepped into that specialty, and how are you executing on that role?
I hope well, but it's been a learning process. And, again, I have a great partner that's allowed me some rope to kind of learn with. So, it's little things. Quantum has a list of investors that they've cultivated over years. It's not big, but they're loyal, community-based type investors. So taking that and saying, okay, how can we, for me, it was like, okay, how can we devise a social media strategy? How can we devise an email drip strategy? So I kind of stay in that lane a little bit, like, okay, I'm going to do all these things to try to market Quantum, the business. Again, it's 506B. I have to be very careful about what I'm marketing. So I'm marketing the business and the performance and the history, the track record, the since 2001 investing sort of thing. The other part with me is like my multifamily partner in all the stuff I own. He's my back end guy. Like he's the guy in the dark basement room with a spreadsheet and loves being there. He's like, you go flap your gums and be the darling of social media if you want to. I want out of it. I brought him in. My share is split equally with him. So like, active campaign integrations and that's him. I just get to write the copy. That's what I'm good at. Right. So I stay in my lane. So that's one aspect. I've got a broad network. I've got a lot of people that I'm very well connected to. I'm in the GoBundance community, which has a certain minimum net worth. So folks that are looking to invest. So cultivating those relationships and bringing them into the world of Quantum Capital and saying, hey, here's an opportunity for you to invest. So I've opened up my network, I guess, from a capital raising perspective to Quantum and added to that list and added to the investor base. Those are the two biggies. And then investor relations wise, I schedule time on my calendar each week for people to jump in if they have questions. So as I send emails out with some regularity, there's a link to schedule time with me if they have questions about the fund, and we'll go through it. And my whole objective in that, honestly, at the beginning of it was sort of like, how do I raise money? So I was going into these calls almost with like an extraction mentality. Like, I need your money. Give me your money so we can invest it. And I really got away from that. Like, how can I add the most value? Which sometimes means, well, this asset isn't what you're looking for. You're looking for more of an A-class asset. Well, let me give you a couple of operators I've invested in. I have no relationship other than investing in them, but there you go if you need it. So I really go at it, these calls, with like zero pressure on the raise and more pressure on, can I maximize the value add for this individual? And that again aligns with who I am and what makes me, I think, effective in the role so far.
Yeah, love that. Yeah, that's definitely the right approach to take. I've approached it both ways, and my goodness, you hit a wall real fast if you're in the capital raising
It's
mode, right?
hard, man, because I
Yeah,
got this guy saying, "Yeah, come on in. We're going to raise this fund," and like it's just hot potato, drop you in there, and that's not on him.
yeah,
That's on me. So my first thing is, okay, I got to go raise capital. I got to, I need to. Please give me your money. Was my aura, right? Like, give me
yeah.
your money was how I was coming across. At least I felt that way. And now it's like, if this works, invest. I believe I invested. Here's why I invested. All that stuff. If it doesn't, explain to me why, and maybe I can help you find a better option for you. So
Absolutely,
that
love it,
feels great.
love it. Well, look, I want to transition a little bit here, and let's talk about this 16 unit deal, C class, C plus value add deal outside of Ann Arbor, Michigan, that you took down with a joint venture structure with 3 other partners. If you can, just maybe describe the asset in general for us.
So yeah, 16 unit garden level type apartment building built in the 60s, early 70s, maybe. It's actually a split up 32 unit. So if you can imagine, there's 4 buildings, each with 8 units, and they're 2 blocks apart. So two buildings next to each other on one block, and then 2 blocks over, 2 buildings next to each other. And whoever at some point in time sold one on one block and one on the other block to one guy, and the other two to the other guy. So when we bought these, we own one on one block and one on the other. And our neighbor, we call him next door, owns the other 2. And we always banter about like who's going to buy who's first. But so these are kind of a standard workforce type housing. The tenants are, the prior owner he had 2 bedrooms, didn't advertise any of them as 2s, all 1s, because he wanted retired people only. He wanted quiet, retired, not very good upkeep, heavy smoking in both buildings. His maintenance tech was unit 1, and you could see from the deferred maintenance in the building that maintenance tech wasn't doing great maintenance. And on top of that, his wife was a smoker with an oxygen tank on. So it's like a huge liability on top of it. So, but it's in a great neighborhood. It's a bedroom community in Ann Arbor. If you don't know Ann Arbor, that's the University of Michigan. Really cool, 150,000 person town. High value rents. People are moving out of there because of it, and they're moving into this town, along with other bedroom communities around it. So just a great find, a great asset that we found in this particular market.
And how did you go about sourcing the deal originally?
Yeah, so it's funny. The first 16 units, the other 16 units we saw listed, and we put an offer in. We got outbid by our neighbor, Rob. That's his name. Ben and I started the multifamily and more meetup, and we started putting these meetings together. And at I think the 3rd or 4th one, this couple comes to us and says, "Hey, we've got this 16 unit property in Pinckney." We're like, "The one on market?" Like, no, the other 2 that's off market. We met the seller. He wants to get rid of it. We've been working with him. We've kind of negotiated the price, but where we are, we can't take it down by ourselves. And it wasn't a very expensive building, but they just weren't in a position at that point to take it down by themselves. Do you guys want to partner? So we got to know them, aligned values, nice people, we knew where they lived and everything. And we decided, sure, we're going to partner up on this deal. And we ended up acquiring it for $755,000. So pretty inexpensive. We were off to the races. That was late 2018, December. It was like right before the New Year's in 2018.
And so, obviously, this is a value add play. You're looking for some opportunity to increase the value here. What was the business plan, or what was the strategy on this one?
Yeah, rents were average $578 per door. We saw the opportunity to be around $700 a door conservatively. We thought $725, but conservatively at the time, we targeted $700 a door. Expense wise, there was, the garbage was probably 3x the need for what, I remember one of our partners called the garbage company, and they're like, "Yeah, we'll drop this in half." Like they just never called. So sure, there you go. You got it in half, stuff like that. So we had some expense mitigation that we saw. There were some water issues, just little things like that. So we saw it as we acquire the building, we push rents over the course of the next couple of years, and we try to refi out. We were thinking about a 1.112 valuation.
Mm-hmm. And so how did you structure it from the beginning? You've got, it sounds like 4 partners, the 2 original, and then you and your partner. How did you structure it, and what was the debt and equities structure looking like?
Yeah, it was. So we did 25%. We just did a split 4 ways, 25% each. We each had a 25% ownership stake. And the debt was, we had a 20-year financing. It was terrible. 20-year term. Well, I say terrible, but it got us our first deal. So 20-year amortization. I believe it was a 5-year term. No prepay. That's good. But it was like 5.99% interest. Yeah, I think that's all. I hit all the debt terms on
Okay.
that. Oh, and 80/20 loan to value. So
Gotcha.
yeah.
All right. And it sounds like you refinanced out of that deal. You were hoping 1.1 or something like that. You refinanced out. Is that correct?
Yeah, we did. So about a year and a half in, a couple of things happened. The partnership was dissolving a little bit. There was a bit of a difference in mindset on what to do. Like we bumped rents a little bit on the existing tenants, but market rents were going higher than what we realized. In fact, it's a small town. We were kind of setting the market, right? There was really no great comps there. So we were, and I say we, my partner Ben and I were of the opinion, like, we got to push rents. We brought in a manager. Our agreement was that Ben and I would own the management and they would own sort of the maintenance and upkeep of the building. So Brent and I brought in a manager, and that wasn't very popular of a decision with our partners, even though, so anyway, it didn't get contentious, but they definitely were like, look, we want to get out. So about a year and a half in, we refied. We started the process, I think in April, 2 months after COVID hit. So, and we got through the process in August. And I remember the valuation came in at 1.04 million, 1,040,000. And the cap rate comps they used were really ridiculous. Like, I don't know how to describe it, but it would be like if you bought a house in Beverly or a property in Beverly Hills and they used comps for cap rate from Compton. It was sort of like that. Like, wow. But the bank was in a position of like, we're not taking any challenges because of the uncertainty. Right. And it's funny, like initially I was like, this is BS, man, 1,040,000. But then I'm like, wait a minute, our partners want out. So the lower value actually served my partner and I, because we essentially gave them all the refi proceeds. That's what we negotiated. Like, we'll just give you the refi and you're out. And we split the building 50-50. Today, gotcha. What's crazy is that was 18 months ago. I mean, inflation does this and everything else. But I mean, we thought, all right, hey, inflation and the demand in that community, we could probably get 850, but one beds are going at 995 and with multiple people asking for them. So we're like, how far do we push this?
Goodness gracious.
We're in this weird place of like, we've got this sort of boutique building in a neighborhood. And, like, do we push these tenants to the point where it's like, sorry, it's 895, 995, or you got to go kind of thing. Yeah. So right now we're sort of piling up the cash in our reserve account so that if we turn some units because we push rents, that we've got that reserve. But we're hoping to refi out, at 1.3, 1.4 in the next year or so.
No, that's great. Well, good for you. That's great. And going back to sourcing this deal, this was all sourced because you started the multifamily and more networking community. Is that correct? Because this came from one of your members of that community.
All the three deals I've talked about, the 16 unit, the 22 unit we acquired, and the third 22 unit, or the second 22 unit that we were under contract with, but wholesale to another buyer, all came from connections through that meetup community for sure. Yeah.
Going back to your superpower of being the networker, the connector, and that's invaluable, right? It's one of those soft skills. It's hard to put tangible numbers on that skill set, right? I mean, you can over time, how much capital you've raised and that type of thing, but it's hard to put an actual number on that and track metrics on that skill set. But obviously it's showing up for you in the deals that you've been able to acquire through those relationships.
Yeah. And really real quick, in any of those three that I talked about, integrator, analyzer, or connector, there's got to be a baseline. Like, you can have that skill, but the baseline has to be, how do I serve? Right. And that's why I said, like, when I was initially raising capital with Quantum, I wasn't thinking about how I can serve. I was thinking about, I guess, how I could serve Quantum, but it was self-serving in that way, as opposed to how can I serve. So being a connector and bringing people together through this networking community, that I've learned, that's foundation of how do I serve, I believe, is what brought us the deal flow that we had. So yeah.
Love it. Well, Jamie, this has been a great conversation. I think it'll resonate with a lot of our listeners that sort of spread the gamut between, investing for their own private portfolio, their own personal portfolio, and in small residential stuff or small multifamily, and then making a transition out of a W-2 space into being a real estate investor full time and joining a team. All this has been great stuff. I appreciate you sharing your journey with us. So that we can learn from what you've done. What's the best way for our listeners to connect with you and learn more about what you guys have going on over at Quantum Capital?
Yeah, the best place for all of it, everything I do, is really to follow me on Instagram. It's at the Jamie Gruber. I put out a lot of content on, leaving your job, what health insurance should I get, all that stuff. But also I talk a lot about what we're doing with Quantum, along with the other stuff that I'm kind of involved in. So at the Jamie Gruber on Instagram.
Awesome. We'll have a link to that in the show notes. If you want to connect with Jamie, go ahead and click on that link down below. Jamie, again, an honor to have you on the show. Thank you for sharing your journey with us. And I look forward to connecting with you again soon.
Damn it. Thanks for having me on. I appreciate it.